you did everything right. You spent decades working, watching what you spent, and putting money aside. And now it's sitting in the bank, earning interest for the first time in years. That feels like a reward, like the system finally working in your favor. Then a letter arrives from HMRC. Not a mistake, not a scam, a genuine tax demand on the interest your savings have been quietly earning. And the number isn't small. For a lot of people with £25,000 or more sitting in a standard savings account at today's rates, that interest has crept past £1,000, which is exactly where HMRC starts taking a cut. This isn't because you did anything wrong. The rules didn't change because of what you did. They changed because of what the government didn't do. They froze the thresholds years ago and left them there while interest rates climbed. Your money didn't move, the goalposts did. And the frustrating part is that most of the advice circulating online was written for people half your age. It doesn't account for where you actually are, past 55, with real savings, real pension access, and options that most people in their 30s or 40s simply don't have yet. Today, I want to walk through exactly what's happening, why it's catching so many people out right now, and, more usefully, 3 specific things you can do to legally protect your savings interest from tax. One of them is sitting in your pension, and most financial channels are telling you to avoid it for completely the wrong reasons. Picture this. You're sitting at the kitchen table, cup of tea going cold, and there's a letter from HMRC telling you your tax code has changed. No phone call, no explanation, just a new code, effective immediately. You ring your bank. Turns out they reported your savings interest directly to HMRC automatically. You didn't do anything. The bank just told them. That's how the system works now. And for a lot of people, it came as a complete shock. So what's actually going on here? For most of the last decade, savings rates were so low that interest barely registered. A typical easy access account was paying 0.1%, maybe 0.5%. If you had £25,000 in the bank, you were earning a couple of £100 a year. Well within the limit, nothing to worry about. Then rates climbed. By 2023 and into 2024, easy access accounts were offering 4.5% to 5%. That same £25,000 is now generating over £1,100 a year. And the personal savings allowance, the amount you're allowed to earn in interest before tax kicks in, has stayed frozen at £1,000 for basic rate taxpayers, and just £500 if you're in the higher rate band. That gap is where the tax bill appears. It's a mechanism called fiscal drag. The government doesn't need to raise your tax rate. They simply hold the allowances still while everything else moves. Your income goes up in nominal terms, your bill goes up, but nothing in the rules visibly changed. It's quiet, and it catches people who aren't watching for it. I was sitting with a friend recently, 62 years old, retired teacher, genuinely careful with money all her life. She showed me the letter. Her tax code had been adjusted because of £1,300 in savings interest. She felt like she was being punished for being sensible. That anger is completely reasonable. The system is designed in a way that quietly erodes the returns on money you've already paid tax on once. You're not imagining it. Now, the obvious first answer is an ISA. Move your savings in, interest grows tax-free, problem solved. And yes, that's right. But there's a specific fear I hear constantly that's stopping people from using their ISA properly. And if you're holding back for this reason, it's costing you. If you've found this useful so far, a like helps me understand we're on the same page, and subscribing means you won't miss what's coming next. Here's the single most common mistake I see with Cash ISAs, and it's not about picking the wrong rate or the wrong provider. It's a belief, a quiet worry that most people never actually say out loud. The fear is this: if you put £20,000 into a Cash ISA and the interest takes the balance to £20,800, you've somehow broken the rules, gone over the limit, done something HMRC will come after you for. That belief is wrong, but it's remarkably widespread. The £20,000 limit applies only to what you pay in, your contributions. Money that the ISA itself generates through interest is completely separate. It doesn't count toward next year's allowance. It doesn't trigger any kind of breach. It just sits there, growing entirely outside the reach of tax. Put £20,000 in during April. By December, at current rates, you might reasonably see £800 in interest, bringing your balance to £20,800. That £800 is not a problem. You can still put another £20,000 in the following April. The interest your ISA earns is not eating into your future allowance. That's the whole point of the wrapper. The government ring-fenced this space specifically so the compounding effect could work without HMRC take us a slack each year. If you pull that interest out because you're worried about going over some imaginary ceiling, you've just moved it back into a taxable environment. You've done HMRC's job for them. Now, premium bonds come up a lot in these conversations, and they're worth a quick mention. The prizes are tax-free, which sounds attractive, and for some people, particularly those who already have their ISA maxed out and want somewhere to park a bit extra, they're a reasonable option. NS&I backs them, so there's no credit risk. But here's the thing. If you're relying on savings interest as part of your actual monthly income, premium bonds aren't reliable in the way a savings account is. The prize rate fluctuates. Some months you win nothing. That unpredictability matters more when you're 60 than when you're 35, and the money is just sitting idle. For most people in this situation, the ISA does the job more cleanly. Predictable, protected, and, once you stop worrying about the £20,000 ceiling, surprisingly straightforward. The ISA is a strong first line of defence, but it only shelters £20,000 a year. If you've recently retired and you're sitting on a larger lump sum, a pension payout, a property sale, an inheritance, the ISA alone won't cover it. And that's exactly where most financial advice gets the next step badly wrong for people your age. Let me tell you about Colin. Colin is 66. He retired last year, and he's living primarily on his state pension, around £11,500 a year. A few years back, he sold the family home, downsized, and ended up with £100,000 sitting in a savings account. At today's rates, that's generating roughly £4,500 in interest annually. When the time came to fill in his self-assessment, Colin sat down at the computer, worked through the online form, and the system flagged a tax liability on that interest. So he paid it, quietly. Assumed that was just how it worked now. He overpaid by thousands of pounds. Legally, he owed nothing. Here's the mechanism. Most people know about the personal savings allowance, the £1,000 basic rate threshold we talked about earlier. What almost nobody knows about, including, apparently, the automated HMRC system, is something called the starting rate for savings. If your non-savings income, things like your state pension, a part-time wage, rental income, falls below £17,570, you may be entitled to receive up to £5,000 in savings interest completely free of tax, on top of your standard £1,000 PSA. That's potentially £6,000 in tax-free interest before a single penny is owed. Run Colin's numbers. His state pension of £11,500 sits below the personal allowance of £12,570. So he hasn't even used his personal allowance yet. There's £1,070 of headroom there. Stack on the £5,000 starting rate. Add the £1,000 PSA. Colin could receive over £7,000 in savings interest without owing a penny in tax. His actual interest was £4,500. He owed nothing. The system didn't tell him that. A few years back, I was helping a relative work through their self-assessment, someone in a not entirely different position to Colin. I remember the moment the HMRC portal started generating a tax figure, and neither of us could immediately work out why. The system doesn't say, by the way, you qualify for starting rate relief. It just runs the numbers as if you don't. You have to know to look for it, know where to enter it, and know that you're entitled to claim it. That's not a minor administrative quirk. It's the kind of gap that costs real money, the sort that would cover a winter's worth of energy bills without blinking. The trade-off is brutal in its simplicity. One wrong click on an automated form, one assumption that the computer must have it right, and a retiree hands over money they were legally entitled to keep. Every year. If you're living primarily on state pension income and you have savings generating interest, this is the first thing worth checking before you move anything, before you restructure anything. The entitlement may already be there. You just need to claim it. That's the starting point for lower-income retirees. But what if your pension income is higher? What if you're nudging into the higher rate band, or you've got a larger pot to protect? That's where most financial channels give advice that was written for someone 20 years younger than you. And it's costing people at your stage of life real money. There's a piece of advice that gets repeated constantly in personal finance. It goes something like this: be careful with pensions. Your money gets locked away. That advice isn't wrong exactly. It's just wrong for you. If you're 55 or older, your pension is already accessible. In 2026, the minimum access age remains 55, which means for anyone watching this in that age bracket, the locked-away argument simply doesn't apply. The money isn't locked. You can reach it. The cage door has been open for years. Most people just never tried the handle. So let me reframe what a pension actually is at your stage of life. Strip away the jargon. A pension, specifically a SIPP, a self-invested personal pension, is a tax-free investment wrapper. Interest, dividends, growth, none of it is touched by HMRC while it stays inside. In that sense, it works identically to an ISA. The difference is that a pension has no annual contribution cap in the same way, and when you pay money in, the government adds tax relief on top. At the basic rate, that's an immediate 20% return before the money has done anything at all. I'll be honest about something. For years I was cautious about recommending pensions to people approaching retirement. The access concern felt real, but working closely with clients in their 50s and early 60s, I realized I was applying a 35-year-old's logic to a 60-year-old situation. The risk profile is completely different. At 55, a pension isn't a distant promise. It's a live account with immediate liquidity and a tax structure that ISAs can't match on the way in. Here's a direct comparison. You have £20,000 sitting in a standard savings account at 5%. That generates £1,000 in interest. Once you're over your PSA, that interest gets taxed. 20% if you're a basic rate taxpayer, 40% if you've tipped into the higher band. Now take that same £20,000 and move it into a SIPP. Choose a money market fund inside the SIPP. These track cash rates closely, so you're getting a return similar to a high street savings account, but with almost no volatility. The interest generated inside the SIPP completely tax-free, and on the way in, HMRC refunds 20% of your contribution automatically. So your £20,000 deposit effectively costs you £16,000 in real terms. Even if you're no longer working, you can still contribute up to £3,600 gross per year into a SIPP and receive tax relief. That's worth knowing if your income has dropped in retirement and you want to keep the mechanism working in your favour. There's also a subtler benefit worth flagging. If your total income is edging toward the higher rate threshold, around £50,270, a SIPP contribution brings that figure down. That can pull you back into the basic rate band, which in turn restores your full £1,000 PSA rather than the £500 you'd get as a higher rate taxpayer. One move, two tax problems solved. The people telling you to avoid pensions are solving a problem you no longer have. Liquidity for you is not the issue it once was. What you actually need is a wrapper that keeps the taxman out of your returns. Your pension at this stage does exactly that, and it does it better than anything else available to you in the UK right now. Two tools, both already within reach. But there's one final obstacle I see holding couples back, and it's not ignorance of the rules, it's something quieter than that. This one doesn't get talked about much. Not because it's complicated, it's actually one of the simpler moves available to a married couple in the UK. It doesn't get talked about because it feels personal, and because it requires a conversation that a lot of couples have quietly been avoiding for years. Here's the situation. One partner, often the husband, though not always, has a larger pension, a higher retirement income, and as a result sits in the higher rate tax band. His savings interest gets taxed at 40%. His wife, meanwhile, spent years working part-time or raising children, has a smaller state pension, and her total income sits well below the personal allowance. She may well qualify for that £5,000 starting rate we discussed earlier. The savings, though, they're sitting in his name, because that's how it's always been. HMRC allows transfers of cash and assets between spouses with no income tax and no capital gains tax. It's clean, it's legal, and it's specifically designed to allow couples to make use of both sets of allowances rather than concentrating everything in the higher earner's name. Run the numbers quickly. Say there's £50,000 in savings generating £2,500 in interest. In his name at 40% tax, £1,000 of that disappears to HMRC every year. Move that £50,000 into her name. Assuming her income qualifies, and that same £2,500 in interest could be entirely tax-free. That's £1,000 a year kept. Real money. The kind that covers a quarterly energy bill without having to think about it. So why doesn't it happen? It's rarely about not knowing the rule. Most couples, when you explain it, say yes, that makes sense. The block is behavioral. Money that's been in one person's name for 30 years carries a kind of psychological ownership that has nothing to do with the law. There's an unspoken sense of this is mine to manage, not through selfishness, but through habit, through the way things were divided up when both partners were working, and it simply felt easier to keep things separate. And then there's the friction of actually doing it. Going into a branch, or navigating an online banking system, or opening a new account in a different name. It never feels urgent. It gets added to the list of things to sort out eventually. Meanwhile, the tax bill arrives on schedule. That reluctance, that low-grade inertia, is completely normal at this stage of life. It's not laziness. It's the weight of 30 years of financial habit. But the cost of leaving it unaddressed compounds quietly, the same way interest does. The conversation with your partner doesn't need to be a formal financial review. It can start with something simple. I watched something that said we might be paying more tax than we need to just because of whose name the savings are in. That's enough to open the door. Ignoring it today means a larger tax bill tomorrow. That's the trade-off. Tax isn't a punishment, but it becomes one when you're paying more of it than the law requires, simply because the right structures aren't in place. 3 things, that's what this comes down to. First, the interest your ISA earns does not count toward your £20,000 annual allowance. It never did. If that fear has been holding you back from letting your ISA do its job properly, you can let it go now. Second, if your main income is the state pension, and it sits below £17,570, you may be entitled to receive up to £5,000 in savings interest completely free of tax, on top of the standard £1,000 PSA. That's a legal entitlement. HMRC's automated system won't volunteer it. You have to know to claim it. Third, if you're 55 or older, your pension is not a locked vault. It's the most tax-efficient wrapper available to you right now. Better than a standard ISA on the way in, equally protected on the way out. The advice telling you to avoid it was written for someone at a different stage of life entirely. None of these require a financial advisor. None of them involve complicated paperwork or risky decisions. They require knowing what you're entitled to and then using it. I'm Arthur. This channel exists for one reason: not to help you get rich quickly, but to make sure you don't lose money you have already earned and already deserve to keep. The UK tax system is not designed to make this easy, but it's not designed to be impossible either. You just need to know where to look. If this video helped you see something more clearly, subscribing means you'll be here for the next one. There's always another layer worth understanding.